View on the Market, a practical view of today's financial markets. Unlock the potential of your portfolio performance by maximizing your investments. Learn how mutual funds, exchange-traded funds, and real estate investments can create diversification. View on the Market starts now.
And welcome to View on the Market. This is a special series, one of three series that has to do with year-end planning, and I'm going to bring in our professional Jim Dowd. But before we do that, we need to let you know that this is just for educational purposes. We don't suggest that you follow everything we're saying, and if you have any questions, contact a certified financial planner for real advice. So my name is Jeff Zayas, and this is View on the Market, and we are going to go to Mr. Jim Dowd. Jim, how are you doing?
I'm doing well, thanks. How are you, Jeff?
I'm doing well as well. So I got a question for you. What should we start doing at the year end? What do you think we should be doing to help plan for the year end?
It's a great question. I mean, a lot of times at this time of year, we're sitting down with our clients and reviewing portfolios, kind of doing year-end checkups. It really kind of starts around November and pretty much goes through the first of the year and even into January, February, all the way up until tax time in the first quarter. But I thought what would be good to focus on, today is really the issues that people need to focus on before the calendar year end date, because there are some particular issues that actually have a calendar year deadline, and if you don't address them before December 31st, then you'll have to wait another year to be able to really take action.
And what is the first thing you think we should be doing as consumers?
Well, the first thing is it doesn't apply to all consumers, but it does apply to small business owners or self-employed individuals who may not have established a retirement plan. And that is to set up a retirement plan before year end. One of the best ways that individuals have to be able to save for retirement, to be able to defer some of their income on a tax preference basis, is through either a self-employed IRA, a SEP IRA, or what's called a solo 401k, which is a particular subcategory of 401k plan that's set up for self-employed individuals and their spouses. So that's kind of the first thing. Those documents have to be done and the accounts have to be created generally before December 31st. And so that's something that if people haven't started yet, they should get a jump on.
And just a follow-up question, can you fund it all at one time?
You can, and in fact, one of the benefits of the solo plan is that you can actually wait until you file your taxes to determine how much you would like to fund it. So in contrast to a traditional 401k plan that some of us might be familiar with from jobs we've had with larger employers, with a solo plan, the plan itself has to be established by year end, but you can actually make the contributions all the way up until your tax filing deadline.
Well, that's perfect, and then you know exactly, how much you can afford, to put in, and what the max limit is, and the benefit of doing it and do it all at once with your when you do your accountant.
That's right, and for a lot of people, they may have a vague idea of what their tax liability is going to be, but until they can really kind of pin it down, they don't want to commit to funding a certain amount. So this really gives them kind of maximum flexibility.
Excellent. And now, what other things you think we should be doing? Charitable funds, or deciding how much you want to give?
Yeah, of course, another deadline that comes up around year end is any type of commitment that we make that that has to be done within the tax year. So charitable donations is a great example of that, and probably a lot of us are getting more higher than usual volume of solicitations around November, December, because most charitable organizations know that people tend to think about charitable giving around the holidays, and also coming up on year end as they're preparing to find out what their deductions look like as they go to do their taxes. So if you do have any charitable giving that you're that you're planning to make, then then a lot of times it's a good idea to get that in before December 31st, so that you can get the deduction for the current tax year.
And that's something that you have to have that check dated by December 31st, correct?
Yeah, generally speaking, and again, this is something you should check with your tax advisor on, but generally speaking, the test that the IRS has tended to use historically is whether or not the gift is actually left to your hands. So if you mail the check before year end, then generally you're going to be okay in terms of being able to take the deduction. What we typically advise is that clients, either get either mail their checks with using certified mail, or using a private carrier where there's evidence that the check was sent before year end for substantiation purposes.
Okay, now you mentioned three things. I think the third thing is my favorite thing. So let's talk about harvesting your winnings or your capital gains.
Okay, well, this is actually kind of a particular situation this year that's a little bit of an anomaly compared to most years. Most years at this time we're talking about harvesting losses, because capital gains and capital losses are typically, at about this time of year whether or not the investments that you have in your taxable accounts have made money or lost money, during the course of the year and sort of over the time period that you've held them. And in most years, we're actually trying to realize losses so that we can take the $3,000 of capital losses against ordinary income, again, against your tax return, if you file on an itemized basis, your deductions. But this year, because there's a high likelihood that capital gains rates are going to rise next year, actually many people are doing the opposite. They're harvesting their gains and realizing capital gains before the end of the year, and establishing a higher basis on their investments, on the capital assets in their investment accounts. And so if you can basically take the gains this year at a 15% or even better, a 10% capital gains rate, or if you're in the right tax bracket, then that gives you a pretty substantial benefit compared to waiting where the gains rate might be 20% or higher next year.
May I ask a quick question? What do you think is going to happen at the end of the year when people are, dumping stocks because of they want to get that capital gains in? You think it's going to drive the stock market down, or you think it's a buying opportunity?
Yeah, that's a great question, Jeff. I mean, a lot of times, every year, market prognosticators, will talk about, loss harvesting, or this year gain harvesting is a driver of the market. And the truth is, it doesn't tend to be a major factor, in my opinion. Really, first of all, most stocks are not held, by individual investors in taxable accounts. When you think about, where you have most of your investments, and where most middle-class Americans have their investments, they actually have them in tax-deferred accounts, such as IRAs or 401k plans. And a lot of the big institutional investors aren't really subject to the same tax constraints that we as individuals are. So there may be some activity kind of up against the calendar year end, but a lot of people have already taken advantage of whatever changes that they're going to make to their portfolio, either in October, November, or or earlier this month.
Oh, so I always talk about Bank of America stock because that's my big thing that I just kind of I guess a hold person. So
Okay.
So to say, if you do have individual stocks and would you sell them? I mean, I hate to ask a question like that, but a lot of people, don't want to take that capital gain, and again, they live in maybe they live in a state where they're not going to pay a sales tax, or that might change as well. So how does that factor into that whole thing?
Right. Well, I guess the first question is kind of where are you going to be in your federal bracket? So if you're currently at a 10% gains bracket for capital gains at the federal level, and you think as we do, that capital gains rates will probably go up next year to 20% or higher, then really it's not an investment decision; it's a tax decision as to whether or not to kind of take that gain now and reestablish the basis. I mean, you can literally sell the stock, pay the gain, and repurchase it the same day. There's not the same kind of delay that's required with capital losses. and the wash sale rules, which prevent somebody from from selling a stock to realize a loss and then immediately you're purchasing it. The IRS is happy to kind of have you pay them tax sooner, so to speak. So that's kind of the first thing. I guess the point you raised about state taxes is a good one, though, and that's that if you think that you're going to be relocating from a high tax state such as California to a state that does not charge capital gains tax such as Nevada or Florida, then you might be just as well off to kind of defer your sale, because what you save on the federal tax you're going to lose on the state tax. If you live in California right now. And then the other factor to kind of think about is, really what your holding period is likely to be on the stock, because, in general, there's kind of a trade-off between the tax deferred value of compounding and the lower tax rate. So the longer you hold the stock, and kind of our rule of thumb is about 10 years. And again, that's just a rule of thumb. But if you think you're going to be holding the position for 10 years or longer, then realizing a gain right now might not make sense.
And again, if you have any questions, you should, contact your financial planner, hopefully Jim Dowd. And number two, talk to your tax accountant, because, this is one of those special times of the year and special times of the last 8 years where there's a lot of circumstances going on, and you don't know what's going to happen. So it's probably a good thing to kind of plan now. Anyways, thank you so much for today's show, and this is segment number 1, and we will do segment number 2 next week. So thank you so much. Again, this was Jim Dowd from North Capital Inc., and located in San Francisco. So Jim, thank you so much.
Thank you, Jeff.
And we'll see you later.